Something quietly shifted in the silver market, and most people have not caught on yet. Not the casual observers who glance at a chart once a month and move on, not the people who dismiss this metal every time it pulls back, but the ones who have real skin in the game, who track physical flows, follow policy language, and understand how the relationship between paper contracts and actual metal works in practice. They can feel it. And today, we are going to work through exactly what that shift is, where it is coming from, and what it might mean for where this market heads next. Before we go deeper, if you are new here at Element Access, hit that subscribe button right now. We do not do surface-level financial takes here. We do the work, dig into the structure behind the headlines, and bring it back in a format that is actually useful for people making real decisions. Subscribe and stick with us. Because if you have spent any serious time around silver over the last few years, you have heard both extremes. You have heard the hyperbulls calling for 4-digit price targets, declaring that the exchange system is days away from collapse, and insisting that a complete reset of the entire pricing structure is right around the corner. And on the other side, you have heard the skeptics who have watched this metal disappoint cycle after cycle and treat every rally as just another head fake. Both of those camps miss something important. And what they both miss is exactly what this conversation is about. So if you are ready to set aside the noise and actually think through what may be meaningfully shifting here, stay with me. By the time we finish, you will have a much clearer picture of what is real, what is exaggerated, and what most people watching this space are still overlooking. The place to start is the paper market, because every time silver begins to show real strength, that is where the conversation goes first. People want to know if the futures-based pricing system is finally showing cracks. They want to know if the decades-long dominance of paper contracts over physical metal is beginning to fracture. These are completely legitimate questions, and they deserve a straight answer. Here is where things actually stand. I do believe something meaningful is happening in the underlying structure of this market. The conditions underneath the surface look tighter, more politically sensitive, and more strategically significant than they have been in a very long time. But honest analysis does not require declaring that the entire paper system is finished and that everything resets by next Tuesday. That kind of declaration is not analysis. It is theater. And it serves the person making it a lot more than it serves you. The futures market is still functioning, still clearing trades, still settling contracts. But the physical market sitting underneath that system has a different character than it did before. It looks tighter. It is drawing a different quality of attention. And the physical side of this equation is carrying a different kind of weight than it was even a few years ago. That matters. These kinds of structural shifts almost never announce themselves cleanly. They build gradually and then suddenly look obvious to everyone at once. Think about where silver has actually been trading. Low 80s, gold sitting comfortably above 5,000. Those numbers would have seemed disconnected from reality to most market observers not long ago. The whole complex has moved into a completely different price range. And when that kind of repricing happens, and the honest question becomes whether you are looking at a cyclical rally that will fade back to the old range, or whether you are looking at something fundamentally different in how this market is being understood and valued. Those are not the same thing, and the answer matters enormously for how you think about positioning. When prices move primarily because of speculative momentum, they tend to fade. Traders push the number up, the trade gets crowded, confidence cracks, and prices come back down. Normal market behavior. But when prices move because physical supply concerns, policy concerns, institutional capital concerns, and geopolitical concerns are all converging on the same asset at the same time, that is a different kind of move entirely. That is what people mean when they use the phrase regime change. Not a dramatic overnight revolution, but a meaningful shift in the weight of different forces competing for control of this market. One of the biggest underlying shifts worth understanding is the question of where the center of gravity for silver pricing actually lives right now. For a very long time, the dominant assumption was clear. Western paper markets, primarily futures trading in the United States, set the price. Everything else followed. I'm no longer as confident in that assumption as I once was. The gravitational pull feels like it is shifting, not in one clean handoff, but gradually in the way demand patterns are evolving, in the way state-level thinking about reserves and strategic materials is changing, and in the way supply chain awareness is elevating the perceived importance of physical access to metals. Asia carries more weight in this conversation than it did before. State-level behavior around hard assets carries more weight. The concept of physical optionality, the actual ability to get your hands on real metal when you need it, carries more weight. And the idea that silver is some antiquated relic without meaningful modern relevance looks weaker with every passing month. Drop a comment below and tell me whether you think this shift is real and lasting, or whether you believe it is being overstated. I read through them, and the discussion on this topic is always worth having. Now, one area where the silver conversation frequently goes off the rails is in the price target discussion. Big numbers get attention. And there's no shortage of big numbers circulating in this community. Inflation-adjusted historical highs get referenced constantly, layered with alternative inflation frameworks. And suddenly, you're staring at a 4-digit target that sounds almost too large to say out loud. People share those numbers, they get traction, and the narrative spreads. Here's the fair version of that argument. There's a legitimate observation buried inside the inflation discussion. Silver's historical peak looks meaningfully different depending on which inflation methodology you apply. Under official consumer price data, the inflation-adjusted equivalent of the old high still sits well above where silver spent most of the last decade. That is a real and honest data point worth knowing. But the moment you leap from silver still has room to silver must reach this extreme figure because my inflation math demands it. You have stopped doing analysis and started running a marketing campaign. And that distinction matters. Because investors who anchor themselves to a specific extreme target tend to make very different and often very costly decisions than the ones who use historical context as a lens rather than a prophecy. The honest framing is this: even under official data, the historical comparison suggests silver has not exhausted every reasonable upside scenario. And if you believe the actual lived cost of living has run hotter than official numbers capture over long periods, the case for higher silver becomes psychologically stronger, not as a guarantee, but as context. Inflation adjustments are not prophecies. They are lenses, not instructions. And the market does not owe anyone a straight line to whatever number the spreadsheet suggests it should be worth. Markets move when real buyers show up in sufficient size, when supply genuinely tightens, when institutions need exposure, and when a story breaks out of its niche and reaches a mainstream crowd. That last ingredient is where a lot of the most interesting potential energy sits right now. Which leads us to something that gets dismissed too quickly by a lot of traditional metals commentary: tokenization. I know that word makes certain people immediately tune out. They hear it and think hype, gimmick, or tech marketing language grafted onto a centuries-old asset. That instinct is understandable, but blanket dismissal would be a mistake, and here is why. The important thing about tokenized precious metals is not the technology itself, it is the behavior it can enable. Tokenized commodity markets have grown to a scale that is no longer purely theoretical. Some of the newer precious metals products are being built around a specific promise. Each digital unit corresponds to real, vaulted, audited physical metal. The pitch has shifted from trust us, the metal is somewhere, to here is the verifiable claim on real metal, and here is how you confirm the custody. That is a genuinely different value proposition. It changes the conversation in two important ways. First, it meaningfully lowers the friction for a younger, more digitally native class of buyers who would never visit a coin dealer or manage physical storage. That is a new demand channel that did not exist in previous silver cycles. Second, if the backing and custody standards are genuine, tokenized bullion creates another pathway through which physical metal can be warehoused and effectively removed from available supply. That is a structural change in how demand can flow into this asset. Now, I want to be careful. Not every product calling itself tokenized precious metals deserves trust. Not every issuer has the legal structure, redemption terms, and audit standards that responsible custody requires. Healthy skepticism is necessary. You need to understand what you actually own, what your redemption rights are, and who holds the physical metal. These are not small details. But skepticism should not become permanent blindness either. Think about what the best version of this model actually offers. Accessibility through platforms that modern buyers already use. And if the backing is real, the old argument between holding metal directly and holding a financial abstraction starts to narrow significantly. For years, you basically had two options: hold coins and bars yourself with all the storage trade-offs, or accept a financial instrument with counterparty exposure. Tokenized bullion tries to thread that needle. Digital mobility with a physical anchor, it may become a meaningful bridge product. And if it does, silver gains a tailwind that older market models simply did not account for. Step back and look at the full picture now. You have a metal trading in a tighter, more volatile environment. You have broad macro uncertainty supporting demand for real assets. You have digital infrastructure expanding access to new buyers. And you have a general public in the United States that does not yet look euphoric about silver. That last point is actually one of the most constructive things you can say about this market right now. The average person is not talking about silver the way people talk at the peak of a major move. There is growing curiosity, more chatter in communities that were not paying attention a couple of years ago. But there is not yet that complete broad-based obsession where everyone becomes an overnight expert. Everyone throws out massive targets, and everyone simultaneously feels early and late. That wave has not broken yet. And if you have been through enough market cycles, you know what it looks like when it does. We are not there. If you are finding this useful, hit the like button right now. It is a small thing that makes a real difference in helping people who need this kind of content find it. Now let us talk about what is actually driving silver demand beyond the fear trade. because the story is richer and more complicated than inflation anxiety alone. Silver sits directly in the middle of several of the most significant structural growth themes in the modern economy. Data center infrastructure build-out for artificial intelligence applications requires electrical components where silver's conductivity properties matter. Advanced automotive electronics, industrial manufacturing technology, and a range of other applications generate demand driven not by investor sentiment but by genuine manufacturing need. These are capital-intensive, long-term infrastructure themes with real staying power. At the same time, one of silver's historically important demand drivers, solar panel manufacturing, has been under efficiency pressure. The solar industry has been actively working to reduce silver content per unit. That means the relationship between solar growth and silver demand is not as positive as it once was. That is a real headwind worth acknowledging honestly. But here's the thing. The strongest investment arguments are not the ones that pretend every variable points in the same direction. They are the ones that remain compelling even after you honestly acknowledge the headwinds, the ones that survive complexity. Silver has that kind of case right now. Mine supply can respond around the edges. Higher prices bring recycled metal out of above-ground sources. The macro backdrop can change. And yet, through all of it, the metal has repriced into a completely different zone than where it spent most of the past decade. Something persistent and meaningful is working underneath the surface. Now let me describe something that I think is genuinely one of the most important structural observations you can make about where silver stands today. The number of separate doorways through which serious people are arriving at the same conversation about this metal is genuinely different from previous cycles. Some come through the inflation doorway. They want exposure to something with intrinsic value that does not depend on a central bank's balance sheet decisions. Some come through the industrial demand doorway. They follow technology and energy infrastructure trends and see silver as a necessary material in applications that will grow regardless of financial market conditions. Some come through the macro hedge doorway. They are watching government debt trajectories, central bank behavior, and geopolitical fragmentation. And they want assets that do not carry someone else's liability embedded in their value. Some arrive through the digital assets doorway. They are fluent in blockchain-based ownership and see tokenized precious metals as a natural extension of that world into something with real physical backing. Some come through the critical minerals doorway. They understand that certain materials are becoming contested geopolitically, and they are starting to recognize silver's role in that dynamic. And some come through the state behavior doorway. They watch how large institutions and sovereign entities reposition relative to hard assets and draw their own conclusions about what those moves signal. When an asset attracts genuine interest from that many directions simultaneously, it no longer needs every buyer to share the same thesis. It just needs enough buyers arriving from enough different angles to maintain consistent demand pressure. That is a fundamentally different and more durable dynamic than the older silver environment, where the bull case depended primarily on a niche community trying to convince everyone else that the market was manipulated and poised for an explosive correction. That story had limited reach. The story now forming around silver is considerably broader and considerably harder to dismiss. And when a conversation like this stops being niche and starts attracting participants from broader institutional worlds, price responses can become nonlinear. The market can sit in a range for an extended period, testing patience. And then suddenly the convergence of forces becomes visible to a wider audience all at once. And the response looks obvious in hindsight, even though almost nobody called the timing. For people in the 45 to 55 and beyond age group, that dynamic should resonate on a gut level. You have lived through enough market cycles to know what that slow build phase feels like, and you have seen how quickly it transitions to the acceleration phase once enough people update their beliefs at once. What has changed today is the speed of that shift. Information travels across platforms in hours. Getting exposure to silver requires nothing more than a phone screen and a few minutes. The gap between most people not caring and most people suddenly feeling like they need exposure may be much shorter than most expect. Now let us get into the government dimension, because this is where the analysis stops being primarily about financial flows and starts touching something with larger implications. Official data has shown China continuing to grow its gold reserve holdings, steadily, persistently, sending a clear message about how they think about reserve assets and monetary sovereignty. That does not automatically translate into them becoming massive direct buyers of silver tomorrow, but it confirms that the hard asset mindset at the sovereign level is serious and sustained. And in the United States, silver has now been formally placed on the official critical minerals list. That may read like a bureaucratic technicality. It is not. Once a material receives critical mineral designation, the entire framing around it changes. It is no longer viewed only through investor sentiment or commodity price cycles. It is viewed through the lens of supply security, industrial resilience, defense and technology requirements, and national strategic interest. Policy priorities shift. Financing programs get oriented around securing supply. International development channels get pointed at resource projects touching on these materials. Does that mean the federal government is about to start stockpiling silver bars next quarter? No. Policy implementation takes time, but labels drive priorities. Priorities influence financing. Financing shapes the supply landscape years down the road. We are already seeing the downstream effects of the broader critical minerals push in how U.S. development finance institutions are engaging with resource projects internationally. That is policy in motion, and it eventually shows up in prices. The broader takeaway is that this market is becoming less casual, less dismissible, more strategically contested, and more politically aware than it has been in recent memory. And when you layer that institutional attention over the public side of the story, the combination gets genuinely interesting. More serious people from adjacent worlds are beginning to pay attention. Macro investors, digital asset professionals, alternative asset allocators, industrial supply chain executives. Capital enters markets in waves. First the specialists, then the generalists, then the crowd after the story has become obvious to everyone. If silver is somewhere between the first wave and the second right now, there is still a meaningful window where the move the crowd eventually participates in has not fully happened yet. Share this video with someone who has been asking questions about silver or where hard assets fit in a portfolio today. That is the most direct way to support research that goes this deep. Now, the one thing I feel strongly enough about to address directly, not every silver-related investment vehicle benefits equally from what is building in the metal itself. People will lay out a compelling, well-researched macro case for silver, and then pivot almost without pausing to a specific small mining company as though the strength of their silver thesis automatically validates the equity investment. That logic does not hold. A favorable backdrop for silver does not erase poor management at a mining company. It does not erase bad debt structures, jurisdiction risk, permitting delays, geological surprises, or operational failures. A rising silver price can create extraordinary leverage in well-run miners with quality assets. But it can also create an environment where people convince themselves a weak company will be saved by the metal price. That is rationalization, not analysis. Keep those two theses clearly separate. The thesis for the metal and the thesis for a specific company are two distinct analytical exercises. Do the work on both independently. Let us bring the full picture together now with a framework that is actually useful going forward. This market does not require a single dramatic catalyst to continue developing in the direction the current evidence suggests. It does not need an exchange failure, a government reset announcement, or one headline that changes everything simultaneously. What it requires is simply for the current collection of forces to keep reinforcing each other. Physical conditions that stay tight, policy frameworks that keep treating metals as strategically important, institutional capital that continues to respect hard assets, digital infrastructure that keeps expanding who can access this market, macro conditions that sustain real asset demand, and a public that is still not fully convinced the move is real. That combination alone can sustain considerable price pressure over time. And if even one additional accelerant enters the picture, whether a physical supply crunch, a broader institutional reallocation into real assets, or a wave of mainstream public attention on compressed digital timelines, then this market can move faster and further than most people on the sidelines are positioned for. Where does all of this leave us? In a market that is clearly more structurally interesting than the outdated silver stereotype would have you believe? In a market that does not need exaggerated claims to make a serious case, because the real case is already substantive on its own terms. You have price strength that has repriced the entire precious metals complex. You have growing policy relevance as governments treat silver as a critical strategic material. You have digital ownership infrastructure expanding the potential buyer base. You have persistent supply deficits being covered by above-ground stock year after year. You have industrial applications in the most important technology growth sectors of the modern economy. And you have a general public that is still skeptical enough of this market that the real broad-based participation phase has not fully arrived yet. That is a serious, multidimensional setup. Not a guarantee, not a promise, but a setup that deserves to be treated as such. Drop a comment below and tell me what you are watching and what you think is the most underappreciated part of this story right now. The back and forth in the comments on videos like this generates some of the most useful discussion of anything we do here, and I appreciate every person who takes the time to share a thoughtful perspective. Do I think silver can continue building from where it stands? Yes. Do I think the old ceiling assumptions that defined this market for most of the past decade have already been broken? Yes. Do I think this market is in the middle of a broader transition from an interesting niche story to a genuine strategic asset that a much wider range of participants will compete for? Yes, I do. But I want to be clear about how I frame this. This is a process, not a fairy tale, not a single moment where everything resolves at once, a process where paper influence still exists, but the relative weight of physical demand keeps growing, A process where official inflation measures tell one version of the story and lived experience tells another. A process where digital ownership models keep expanding who can participate. A process where governments increasingly recognize that metals are genuine leverage points in economic and geopolitical competition. A process where silver is being rediscovered by multiple audiences approaching from different angles. That is why this moment feels structurally different from previous silver rallies that ultimately fizzled. Because the argument has become genuinely multi-layered, and multi-layered arguments last longer and travel further than single-trigger narratives built on one fear or one catalyst. Silver does not need fantasy to be compelling right now. The real foundation is already there. Keep watching the physical side of this market. Keep watching the policy language around critical materials. Keep watching whether digital bullion products continue gaining real traction with new audiences. Keep watching whether the public moves from curiosity into genuine, broad conviction. And pay attention to how the market handles significant price pullbacks. If every meaningful dip continues to be treated as an opportunity rather than a warning, that pattern is telling you something important about who holds this metal, how committed they are, and what it would truly take to shake them out. None of what we have covered is a promise about what happens next. This is not personalized financial advice. Everything here is research-based analysis intended to help you think more clearly about what is happening and what deserves your attention. Use it as a framework. Question anything that does not align with what you observe in the real world, and always make your own decisions with full awareness of your own circumstances and risk. If this conversation gave you something useful, subscribe to Element Axis if you have not already. Hit the like button, leave your thoughts in the comments, and share this with someone wrestling with the same questions. That is the most meaningful way to support independent research that goes this deep. We will see you in the next one.